Welcome to another edition of Econ Updates. I'm Steve Taddy, Chief Economist with Hoyle Cohen Wealth Management. Now, as we bring 2023 to a close, I think the year can be summed up in a couple words: better than expected and better than feared, with respect to economic growth and inflation data. Now, as a firm, we were a bit more optimistic than the pack on both, and as more jumped on our train, it propelled the markets forward, with the S&P 500 set to close at or near an all-time high, and it's taken the yield on the 10-year Treasury from about 5% to under 4%. Now, Santa Claus did come to town, and he did bring higher valuations in his sleigh, with the highest of those valuations reserved for the top 10 companies in the S&P 500. The top 10 companies represent about 31% of the index, with Apple and Microsoft alone accounting for 14%. The valuation attributable to the S&P 500 is 20 times next 12 months earnings. Compare that to mid and small cap stocks at about 14 times forward earnings, and international and emerging market companies trading at about 13 and 12 times earnings respectively. The big catalyst for the year, the Federal Reserve. They went from tightening to neutral to now talk of easing in the years ahead. How much easing they will do, it's anybody's guess. But with the Fed funds rate at a 5.25, 5.5 band, and inflation under 3, the Fed has about a 2.5% spread above inflation with which to work with. Now, historically, that's been the top end of their band, and they work to keep that band narrow. We've talked about that before. So I think the Fed is in a position to where they want to lower rates as opposed to being forced to lower rates. And I think that's an important change in rhetoric, because I think we have to take a look at what the Fed's accomplished. They've done a wonderful job of managing the financial plumbing of our economy. They've got a lot of naysayers, but we've got decent economic growth, we've got a decent job market, and inflation is coming under control, with the year ahead of us expected to be at about 2% or lower on inflation. I think it's hats off to a good job. Now, with the 10-year Treasury yield dropping from about 5 to under 4, it lowers the cost of capital for companies that need to borrow money. That's a good thing, because that allows the positive market sentiment that has, infected the market in a good way and taking valuations higher to broaden out that positive investment sentiment to include the other 490 stocks in the S&P 500, mid-cap stocks, small-cap stocks, international stocks, emerging market stocks, private investments. All these things have costs of capital to deal with. And with lower cost of capital, more projects are profitable. And with rising productivity, more companies can be more profitable. That probably leads to earnings filling in the gap between rising valuations and stock prices. So what can go wrong with that? Well, earnings could not fill in the gap. We could have an earnings recession. It doesn't seem very likely, but that is a possibility, that earnings just don't match the expectations in the companies. Another thought is that prior tightening, the delayed impact on prior tightening moves, has a heavier impact in a negative way on the economy. The Fed mismanages the financial plumbing going forward. Probably low odds of that, but it is certainly a possibility. And lastly, any one of a number of the geopolitical issues that abound right now could go white hot. And that could take most any market down, almost any investment down with it. But that's kind of normal. The market always climbs a wall of worry. And let's not forget, it's an election year. So fun times ahead for sure in 2024, but a good spot to start the year with a good economy, a good jobs market, rising equity values in both homes and portfolios. It's all about the revenue and the earnings growth from here. Thanks for tuning in, and Happy New Year.